Hello everyone, and welcome to CDIAC and CMTA's Fundamentals of Public Funds Investing. This is Session 1, an Introduction to Public Funds Investing. I'm Rick Phillips, the President and Chief Investment Officer of FHN Financial Main Street Advisors. Here's a brief background about myself. I started my career in public funds investing about 31 years ago at the City of Las Vegas in 1989. I worked there for about 8 years and then moved over to Clark County, Nevada and was the Chief Investment Officer from 1998 to 2005. In 2005, I decided to start FHN Main Street Advisors. We are an SEC registered investment advisor and we provide management and consulting services on over 50 plus billion of assets under management for states and local agencies. I'm also the founder of the Government Investment Officers Association, GIOA. In today's session, I'll be discussing the primary investment program objectives, safety, liquidity, and income, often known as SLI. Also, I'll talk about roles and responsibilities of the different individuals involved in the investment program, liabilities and ethical issues, and spend most of the time on terms, concepts, and principles. First off, investment program objectives. Your entity's investment policy probably has similar language to these three paragraphs. Number one, safety of principal is the foremost objective of the city, county, district's investment program. Investments by the treasurer or finance director shall be undertaken in a manner that seeks to ensure preservation of capital in the overall portfolio. To attain this objective, diversification of security types, sectors, issuers, and maturities is necessary in order that potential losses on individual securities do not exceed the income generated from the remainder of the portfolio. That doesn't necessarily mean in this type of policy that you're precluded in taking losses. You might have a declining credit that you're worried about and you want to sell that because you might think the price might decline a lot more. Number two, and I always say 1A for liquidity, the investment portfolio shall be structured to timely meet expected cash outflow needs and associated obligations which might be reasonably anticipated. Very important that reasonably anticipated. This objective shall be achieved by matching investment maturities with forecasted cash outflows and maintaining an additional liquidity buffer for unexpected liabilities. I'll talk a little bit later about the balance between having too much liquidity and earning a return, a higher rate of return. And that leads us to the third objective, investment income. The investment portfolio shall be designed to earn a market rate of investment income in relation to prevailing budget and economic cycles, while taking into account investment risk constraints and liquidity needs of the portfolio. One of the later presenters will talk about benchmarking the portfolio in different ways that is the appropriate way to benchmark the portfolio. Now let's talk about roles and responsibilities. One of the primary responsibilities of some involved with the investment program is to act as a fiduciary and also to adhere to a certain standard of prudence. California Code Section 27000.3 states, with regard to county funds deposited in the county treasury, the Board of Supervisors is the agent of the county who serves as a fiduciary and is subject to the prudent investor standard unless a delegation has occurred pursuant to Section 53607. That is typically the case in the state that's delegated to the county treasurer, which paragraph 2 states the county treasurer serves also as a fiduciary subject to the prudent investor standard. And part of that standard, highlighted in red, is that a prudent person acting in a like capacity and familiarity with those matters would use in the conduct of funds of like character and with like aims to safeguard the principal and maintain the liquidity needs of the county and the other depositors. And Code Section 53600.3 broadens that out, not just for the counties, but it states all governing bodies of local agencies or persons authorized to make investment decisions on behalf of those local agencies investing public funds pursuant to this chapter are trustees and therefore fiduciaries subject to the prudent investor standard. Now, of course, you can get a lot of great information by reading state code. Sometimes it's a little cumbersome, written by attorneys. And so one of the best resources I use are these two, actually on the screen you see there, the California Public Fund Investment Primer from CDIAC, and also I serve on the committee for the local agency investment guidelines. I have both of those at the ready as PDFs saved on my desktop as I've used them many, many times over the years. This chart is from the investment primer, the public fund investment participants' typical reporting responsibilities. And I'm going to talk more in depth about the ones where I have the green stars, the Oversight Advisory Committee, investment officials, investment advisors, and broker-dealers. This slide shows the different types of investment programs. Internally managed, that's how I did it at the City of Las Vegas and also at Clark County. The next four involve working with an investment advisor, where it's internally managed by in-house staff at the city or the county, and then you have an investment advisor acting as a consultant in providing research or reporting, compliance, things like that. And then you might have a mixture of internal management and external management. We have clients that do that. We sometimes manage the longer portion of the portfolio and they manage the shorter portion of the portfolio. And then just full externally managed where it's non-discretionary, where you need to get approval of the finance director or treasurer to make a trade. And then fully externally managed where it's discretionary, you just act in that capacity, that fiduciary capacity, of course, and just make the decisions and report to the entity. This slide shows a picture of our busy finance director. You can see she has a lot of arms, wearing many hats, involved with the investment of surplus funds, banking and cash management, custodial and trustee relationships, bond issuance, reporting, and has to figure out segregation of duties. Hopefully she has enough staff to do that. Now let's talk a minute about Treasury Oversight or Advisory Committees. California Code doesn't give a lot of information, but it says the Board of Supervisors in each county may, and I certainly suggest that you do, at your county or your city or your district, establish a County Treasury Oversight Committee, and which shall consist of 3 to 11 members in the categories from which the members shall represent. And from the investment primer over here, it says why California Code describes in great detail the composition of, as well as the restrictions on, the membership of county oversight committees. It provides minimum guidance regarding the duties of committees. Again, I think it's super important for you to have an oversight committee made up of the finance director, maybe someone from your controller's office or audit, something like that. Just another set of eyes for you to explain what's going on with the investment program. We have some of our entities that meet once a year as an investment advisory committee and some that meet quarterly. You'll have to figure out that balance. I think maybe the sweet spot twice a year is a good thing to consider. Now that busy finance director, she might decide that it would be beneficial for her entity to work with an investment advisor in one of the different roles or capacities I mentioned a few minutes ago. And I would suggest that you select an investment advisor that works exclusively or primarily with public fund entities. It's a very different space than the Wall Street approach or pension funds, things like that, to work with public operating funds and bond funds. There are probably about 15 to 20 around the country and about 5 or 6 in the state of California that work primarily or exclusively with public funds. Investment advisors are registered with the Securities and Exchange Commission or the state. Now, you want to work with one that is an SEC registered investment advisor because that's one that has over 150 or 100 million under management. So you want a firm that deals with big dollars. You can also get more information with the ADB Parts 1 and 2 from the SEC Public Disclosure website. And of course, you want to go through the RFP process. Before you start the RFP process, you can go out on the SEC's website and get information about the firms that have submitted or even that you're thinking about, you're going to submit, I should say. And so here's an example looking at our firm. You can see I went out and searched the firm, FHN Financial Main Street. You get information and like 30, 40 pages depending on how much has been filed by the firm. And also as an individual, Richard Phillips, my given name there. And you can see information about years of experience in the private sector, any disclosures you have to worry about. And then also you might want to make sure that they're registered with the Secretary of State in California. And so you can see our firm, the full name there, registered with the California Secretary of State. Now let's shift gears and talk about broker-dealers. They differ from investment advisors. Investment advisors have a fiduciary responsibility where broker-dealers do not. And so broker-dealer, it's a generic term for both brokers and dealers. Both are financial intermediaries that help individuals and entities with money to invest, and they connect those needing capital to build and sustain enterprises such as a city or a county. And firms can act as both a broker and a dealer. So from the table, you see a broker executes customer orders, charges a commission, and must disclose the amount of commission. That's typically not in the fixed income area. There's not commissions on bonds, so it's more that you're dealing with a dealer, even though we use that interchangeable term, because a dealer participates in the trade as a principal, charges a markup or markdown that you don't really see, makes a market in the security, and must disclose the fact that they are a market maker, but not the amount of the markup or markdown. Now you can go out on the FINRA website and under broker check and look at the individual and the firm to get more information about the broker dealers you work with. Now on to the next section, liabilities and ethical issues. There are many sections in government code that deal with our responsibilities and liabilities of those of us who are involved with the investment program. I've listed a few at the bottom. There's probably more, but these are the ones that I could find. And so here's a table that shows the Treasury and investment positions from the Board of Supervisors down to the investment advisors, who has fiduciary responsibility, basically everyone except the accountants and the auditors, and then who has personal liability, the Board of Supervisors down to the investment analyst. With all those fiduciary responsibilities I just mentioned, it's very important to have checks and balances and internal controls to make sure we are doing things that are legal, but also suitable for our entity. We all probably remember Orange County had to file bankruptcy in 1994, not due to something that they were doing that was illegal, but probably wasn't suitable for an investment fund. They were earning much greater returns than other counties in the state because they were employing a strategy called securities lending and levering up the portfolio and taking an interest rate bet. And when interest rates really skyrocketed in 1994, the Fed raised Fed funds from 3 to 6%. Their interest rate bet really went against them and lost billions of dollars for the county. Again, legal, but not suitable. Now let's talk about some things that were not legal. In 1995, there was the Weimar fraud, institutional treasury management, and if I recall correctly, they were pledging collateral for repos with the same collateral to multiple different clients, and then ran into some problems with the markets at that time. And then in 1995, the same year, the city of Vista, an experienced finance director was investing the portfolio but began taking gratuities from a broker and had to plead guilty for fraud after millions of dollars in losses. Again, very important to have that oversight committee, internal controls to make sure that you're looking underneath all the rocks and things are above board and not just, of course, legal, but also suitable for your investment program. Now let's turn to terms, concepts, and principles. Before I get into those, let me touch on the 7 habits of highly effective investment programs. I borrowed this concept from the great book by Stephen R. Covey, The 7 Habits of Highly Effective People. I gave this presentation a year ago in January of 2000 at the annual CSMFO conference in Disneyland. It seems so long ago, of course, of all that's happened this past year due to COVID. So number 1, you have a detailed asset liability matching model, aka a cash flow model. Number 2, you have a responsible amount of interest rate risk and credit risk. 3, you don't try to time the market. 4, you love losses and hate gains, the unrealized kind. 5, you follow GAAP, generally accepted accounting principles. Number 6, you benchmark your investment program and portfolio in multiple ways. And to cap that all off, you provide quality, timely, transparent reporting of these taxpayer funds that you oversee. The other presenters will get more in depth on these principles. I'll touch on a few of them, but I just wanted to give you a checklist on how you could look at an overall perspective of your investment program to make sure you're doing the best principles. One of the main concepts and principles that I've realized over my many years of involvement in public funds is that the investment portfolio is the only area of state and local governments where income can be generated without charging taxes or fees to the citizenry. Of course, safety and liquidity are 1 and 1A in the primary objectives, but the income generated provides valuable services to your entity. So I'm going to be covering today financial markets overview, time value of money, details of debt instruments, and end with the relationship between return and risk. Let's go back to the basics and talk about the purposes of capital. Way back when, we had a barter system, and that still is in place today, of course, but that's when we would trade goods for goods or services for services between two parties. And then that was before really we had widespread and accepted money. And then we created the capital markets channel where we had savings and investments. On the left side, you see the suppliers of capital, retail investors and institutional investors, your entities and institutional investor. And then the users of capital, businesses, governments, individuals. Of course, we have primary and secondary markets. Here are the different market sectors in our financial markets, in our capital structure. Fixed income, which of course you're involved in with the bond market and your investments for your entity. The equity markets, foreign exchange, which is a huge market and impacts all the other markets. Commodities such as oil and gold. Futures market, which surprisingly is allowed by California code, which I really recommend that you don't invest in or participate in with your entity's funds. Derivatives, interbank lending, and cryptocurrency. What an amazing year and decade Bitcoin has had. Some of the sectors or instruments I just mentioned trade on exchanges. Examples of these would be the NYSE, the New York Stock Exchange, the CME, the Chicago Mercantile Exchange, or the CBOE, the Chicago Board Options Exchange. They're highly organized markets. They centrally clear trades. The securities include equities, commodities, forex, futures, and options. They have standardized instruments which lead to a high degree of transparency, and the trades are publicly disseminated, which typically give you a higher degree of liquidity in exchange traded securities. And I love this picture on the right with Dan Aykroyd and Eddie Murphy from that great movie Trading Places at the NYMEX, the New York Mercantile Exchange, trading in the orange juice futures pit. The market that you use for your entity's investments in the fixed income area is over the counter. You can see a picture here of one of the primary dealers' trading desk. There's a group of primary dealers and secondary dealers that trade bonds, not in an exchange. And so examples of things that trade over the counter, of course, bonds, swaps, credit default swaps, bulletin board stocks, and derivatives. Transactions are done directly between two parties, you and the broker-dealer. Market makers in the OTC drive liquidity that allows for customization of securities to fit both parties' needs. For example, you could tailor a callable security how you really want it, or a bullet security. But then you have exposure to counterparty risk in settlement. It's an understatement to say there's lots of regulation involved with the financial markets. First, of course, we have the Federal Reserve System, the Securities and Exchange Commission, FINRA, the Office of Comptroller and Currency, the Commodity Futures Trading Commission, FDIC, Federal Deposit Insurance Corporation, and SIFMA. Now let's talk about the time value of money. A good friend of mine, Kevin Webb, who's one of the other presenters you'll hear a little later, he told me a long time ago, this is the best definition that he ever heard regarding the time value of money, that I want more money and I want it sooner. Of course, we know there's present value and future value of money based upon interest rates. So just very simple math, our future value is the present value, $100, times the interest rate of 5%, we get $105. If we want to find the present value of future money, we can just do that algebra and take the future value, divide it by 1 plus the interest rate, and we get our 100. And then we can compound it, because in bonds we get typically coupon payments that we could reinvest. And so compounding, we show the present value times 1 plus the interest rate raised to the number of periods gives us our future value for compounding. So for example, that same $100 at 5%, but if we get 2 coupon payments per year, we see we get a few more pennies, which adds up to millions and billions of dollars in the capital markets through compounding. In fact, Albert Einstein is credited as saying compound interest is the 8th wonder of the world. So let's look up on the right-hand side of the screen and we look at a bond cash flow example. We could buy a bond at 5%. Wouldn't that be great in this low interest rate environment as we start 2021? And so we see a 2-year maturity, our initial investment of $10,000. So every 6 months, we're going to receive a coupon payment of $250 at 5% divided by 2. And so over the 24 months, we will receive $1,000 of interest, and then we get our maturity back. Now, but over time there could be inflation that eats away at that. And we see here's the buying power of $1 over time from 1920 to 2020, with inflation eating away a huge chunk of that money over time. Here's a long-term look at inflation going back to 1872. I don't know how great the statistics and accuracy. This chart shows the official Consumer Price Index published by the Bureau of Labor Statistics, which began tracking inflation in 1913. The earlier metrics are from Warren and Pearson's Price Index. We just see a huge amount of volatility in the leading up until really the Great Depression in the 1930s, and then it kind of slows down. We don't have as much deflation below the line there, but just this huge spikes that'll be really hard to manage. And in fact, the Federal Reserve started in 1913 and started to monitor and kind of moderate the economy, even though you can see a lot of inflation over time that we've had to put price controls into World War II, stagflation in the early 80s. But you really see the last 40 years from the early 80s till now, we've had inflation trending lower and much more, not as volatile as well. As I mentioned earlier, inflation does eat away at our purchasing power over the long run. So if we own a bond with a fixed coupon and we have high inflation, that makes the value of that coupon payment down the road not worth as much. And so we see on this chart from the Federal Reserve, St. Louis Federal Reserve Fred's database, a great free resource. I use it all the time. You can actually download the data into Excel if you want from this graph. And so you see on the graph the Consumer Price Index, the blue line, and the 10-year Treasuries rate is the red line. And so you see there's a fairly strong correlation between interest rates and inflation. Again, because if inflation's going up, a bond investor is going to demand a higher coupon or interest rate to offset that purchasing power being eaten away over the long term. But again, you can see over the last 40 years, we've had very low, a trending lower inflation, and over the last decade, below 2% on the Fed's main measure of personal consumption expenditure. One of my favorite series on Netflix is Stranger Things, and you might, if you watch that, you remember the Upside Down. Here is a table showing treasury rates around the world, and you can see the negative rates in many parts of the world, namely in Europe and Japan, and just the green, the low rates that we have in many other developed parts of the world. I snipped this back in December, and you can just see that it is upside down, where the government gets paid to borrow money and investors get penalized to buy their bonds. I won't get into the nuances of why they're doing that, to help their currency and trade and things like that, to push their currency down. But it really is upside down, and so if you have any inflation in your country, you're getting killed by investing in negative rates. Even you can see where I've circled our low rates of our 1 year at 8 basis points out to our 30-year at 1.63 back in December of 2020. Incredibly low rates that we've had for many years. Next, I'm going to get in a little more detail about the debt instruments that are allowed in state code. Treasuries, GSEs or federal agency obligations, commercial paper, certificates of deposit, corporate securities, medium-term notes are called in code, certificates of deposit placement services, time deposits, bankers' acceptances, which really aren't issued much anymore, money market mutual funds, and then mutual funds, local government investment pools, LAIF for California, joint power authority pools, mortgage-backed securities, asset-backed securities, repurchase agreements, municipal securities, supranational securities, which were approved just a few years ago in code, securities lending and reverse repurchase agreements, guaranteed investment contracts, collateralized investment agreements, foreign securities, and futures. There are different types of structures for these different fixed income instruments and agreements that we have. So for example, let's talk about discount items. So here's a treasury bill. You see from the Bloomberg screen, it has a QSIP, which would be its identification number. The left arrow shows it's trading at a discount, which means you look on the right-hand side, if you buy $1 million, yielding right around 1%, I put the price at 99, you can see that you're going to pay $990,000 You don't get any coupon or interest payments. It matures. When it matures, you get $1 million. So that's a discounted item. Commercial paper generally is a discounted item. Agency discount notes in the name. Here's a fixed rate structure, which probably most of you would buy the majority of your portfolio with those. It's a treasury note. We can see the coupon with the left arrow, 0.125. You can see the details and the description page on the left. And then you see on the right-hand side, bought 1 million, paid slightly over par and 1/32. Bonds trade in 30 seconds, at least treasury bonds do. And so we see with the yield there right around 11 basis points, 0.109. And so the price ends up being $1,312,050. And since I didn't buy it brand new, it has 14 days of accrued interest at $48.08. And so we see also Bloomberg can show, and other programs can show those coupon payments that you're going to get, the 0.125 or $625 every 6 months, and then your $1 million principal back when it matures. Here's an example of a floating rate structure issued by one of the government-sponsored entities, the GSE or agency Farmer Mac. And you can see that it has floating on the left-hand side. I've circled that in yellow. And SOFR is the floating rate instrument. I'll talk about that in a minute. So its maturity is a little over less than a year, 9/1/21. And it's a bullet, means it can't be called, just right below that. And then on the right-hand side, it has no cap or no floor. And so there was a recent change in state code that allows you to own a negative yielding or accrual instrument that could produce that. And so, for example, if, heaven forbid, interest rates go negative in the United States, that rate could go negative. You see I've circled in yellow on the right-hand side, its coupon, which changes every day, which has a lot of mechanical and operational cost to it to be able to buy a SOFR floater, which resets each day. And we can see it started at 11 at the bottom, hits 12, 10, and back up to 11. On this graph, I compare the SOFR rate, or secured overnight financing rate, as compared to Fed funds. You see they're very much tied together, except there was this huge spike back in September of 2019, and there was some tightness in the repo market, and we'll get into the details. It really shot rates up. In fact, we do repo. We manage the state of Nevada's LGIP, the LAIF of Nevada, and we were able to get in that low rate environment in 2019 over a 5% repo for that day. You also sometimes see spikes at year end. You see the yellow one on the left. That's right at year end where dealers need financing and they might pay up for money to get in repo to give you their security of treasuries as the collateral, and so they'll pay up a little bit for that. But that was a huge spike, of course, that you see back in 2019. So the floating rate instruments are very closely tied to Fed funds, and so of course very low right now in their rates. As I mentioned earlier, in the over-the-counter market that the fixed income bonds trade in, you can have structures. They don't have to be standardized. So for example, here is a fixed to float instrument. So this is a Wells Fargo Bank corporate note issued, and you see the coupon 2.897, and what it's going to do, it's going to have a fixed coupon for a while, and then it's going to float. So for example, we see that 289 has that all the way up to 527.21, and then it's going to float off of 3-month LIBOR plus 61 basis points on the right-hand side of your screen, that green arrow there. So again, some operational cost, although this floats, its coupon doesn't reset daily like the SOFR floater I just showed you, but only quarterly with 3-month LIBOR when it changes. And so these instruments, floating rate instruments, as I talked about in my 7 habits, they're more timing the market. If you think interest rates are going to go up, you would rather own a floater instead of a fixed rate, because if you bought this fixed to float bond, you might think interest rates are stable for a while and then going to go up down the road, and so you want to participate in that going up by having a floating rate instrument. Now let's talk about callable bonds, popular with many state and local governments. So there are different names depending on the different structures that they have. So for example, and they really were based on the European and American, based upon the equity markets when you would do a call option or a put option on a stock. So in Europe, stock options trade with, you can only call them one time, so it's a European or a one-time call, where American call options, they can be called any day past a certain period. Well, the financial engineers many years ago decided, let's have a blend between the two. So let's create an over-the-counter bond instrument, a Bermudan call, which would be callable on every coupon date, every 6 months, for example. And then they decided, well, let's even blend that more. Let's have a canary, which has a one-time call. Sorry, it has Bermuda calls for a while. Let's say for the first year, it's quarterly callable. And then it has a one-time call. And then a Verde is a blend of a Bermuda and a canary, just to get more financial engineering going on. Let me get a little more in depth with callable bonds. So in the top box, when you purchase a callable bond, you are selling a call option to the issuer, such as Fannie Mae. This gives them the right to call the bond when it's advantageous for them and not you. So if interest rates are going down, they're definitely, well, highly probable to call that bond away from you, and you would have to reinvest at a lower rate because they have the right to do it. You have the obligation that you have to give them the bond back and get your money back to reinvest at lower rates. So let's compare. This data was from mid-December 2020. So I have a treasury, of course, no calls, although there used to be callable treasuries. They've all matured now. They don't issue those anymore. And this was a 5-year, had a 37 basis point yield. An agency or GSA bullet at the time had a 7 basis point pickup or spread to that callable, or sorry, to that treasury. And there's a one-time call, a European call. You pick up about 12 basis points more at 56 basis points. All these spreads have tightened now, so we're into January of 2021. A discrete or Bermuda call has 15 calls over that time period. It has a 1-year lockout, and that's callable every quarter, except of course that last 3 months. And so that you get a little bit more, 62 basis points. And then a continuous call, an American call, once it goes past the 1-year lockout, it has 1,450 times that it could get called away from you. And so you get a little bit more for that ability for them to call it more frequently, so you get another 10 basis points as compared to the discrete call. So there's models on Bloomberg and other systems that can model to see what is the value of the call that you're buying as compared to a non-callable. And so you can see on the right-hand side, I did a graph of looking 2 years, 3-year, 4-year, and 5-year, and putting treasuries, bullets all the way up to the 3-month lockout with a quarterly call. And of course, so the more opportunities that you're giving Fannie Mae, for example, to take that bond away from you and give you your money back at lower rates, you're going to get paid a little bit more. But you see my red down at the bottom, I'm going to get into in a minute here. Over the long run, bullets or non-callables have outperformed callables. And so that's something you just have to think about. Callables are more of a timing the market aspect because they will do better if interest rates go up, and you get to realize that call option premium in the sense that you get a higher coupon. That's the premium I'm talking about for when interest rates go up and it doesn't get called away from you. On this screen, let's talk about buying a callable at a premium and a callable at a discount. What is your yield? And so we see on the left-hand side, I paid, it's circled in red, a 101. So I paid a premium of $1 over the bond. And so this coupon in the upper left is a Fannie Mae 5/8, so 0.625, a 5-year. And so you can see the yield to maturity, instead of a 0.625, dropped down to 0.422. And of course, if it gets called away from you, if interest rates drop so much that in a year from now, in 6/30/21, actually 6 months from now, you would actually have a negative yield because you haven't had enough time of getting coupons to eat away at that 101 price that you paid. On the right-hand side, you buy a callable at a discount. So the same bond, you paid 99 for it. And so your yield to maturity is 83 basis points. And then if it gets called in 6 months, really jumps up and so you get a 2.65. So callable bonds have large reinvestment risk depending on, mainly, of course, if interest rates go down. On this slide, I compare the long-term returns of bullets versus callables. So the white line is the 1 to 5 year agency bullet, so all the agency bullets that fit into that index, and then the dashed orange line, the 1 to 5 agency callables. So I went as far back as these two indexes start, back to June 30, 2000, and so almost a 20-year period, actually slightly over a 20-year period to October 2020, when I snipped this slide. And so I know that you spend your coupon payments, your interest payments in your portfolio as part of your budget, but let's just say that you did a buy and hold strategy and you put in $100 into both of these indexes over time, and you can just see the agency bullets, you start with $100, you get $207 at the end as compared to $171 for the 1 to 5 year agency callables. And if you just do simple math, it's approximately 182 basis points per year over this 20-year period that bullets outperform callables. Now, bullets should have outperformed callables because they actually have more interest rate risk, a longer duration, even though they're the same 1 to 5 years for both of them. So let me get into that in a few minutes. On the last slide, I was comparing 1 to 5 year agency bullets to 1 to 5 year agency callables. And I mentioned that the duration is a lot greater on the bullets than the callables, and so it should have outperformed over the long run because higher duration outperforms shorter duration over the long run. You take more risk, interest rate risk, you're going to be compensated over the long run. So to get a little more apples to apples, what I did on this is compare 1 to 3 year bullets, so a shorter duration, much closer to the callables duration of the 1 to 5 year callables. So you have shorter bullets versus longer callables, and you still see the outperformance of the bullets. So 188 versus 171, 17.8% over that 20-year period, or 89 basis points per year. So callables, more of timing the market, a challenging aspect over the long run to outperform bullets. Now I'm going to get a little more in the weeds talking about duration, because that is really the biggest driver of interest rate risk for bonds that don't have credit risk. And so we just see here on my graph, we see the coupon in the middle is the balancing act. So if we buy a bond at par, it just has a nice straight line. But if we pay a premium, we're going to pay above par. It's going to work down to par over time. We have to eat away that coupon. If we buy a discount, the same, you see it going up to the right. And you can look at the current yield, yield to maturity, yield to call, and yield to worst, different calculations that you'll have the PDF that you can go study those out. Now here's me many years ago when I had dark hair as a young portfolio manager at the city of Las Vegas, asking the question, between interest rate risk and credit risk, which risk has the largest long-term impact on my investment income? Well, for 99% of portfolios that I've studied, it's interest rate risk. Public funds, we don't take a lot of credit risk, even though there certainly have been some defaults over the years, Lehman Brothers, etc. Interest rate risk is definitely the biggest driver for the majority of portfolios that I've seen. Now let me get a little more in depth about duration. So duration is measuring the timing of cash flows such as interest payments or principal repayment to be received from a given fixed income security. And it's based upon 3 variables: maturity, coupon rate, and yield to maturity. Duration of a security is a useful indicator of its price volatility given changes in interest rates. So basically, if we have a bond that has a 2 duration and interest rates change by 1%, let's say they go up, the value of that bond would go down by 2% and vice versa. So duration was developed by Frederick Macaulay and named Macaulay duration back in 1938. And it's the only one that's quoted in years, actually. And because he was measuring the years to recover the true cost of a bond, talking about the present value of all the coupon and principal payments received in the future. But then we had modified duration that expanded on Macaulay duration because that measures the responsiveness of a bond's price to its changes in interest rates, as I just described. Then to complicate things even a bit more, those first two are great for bullet securities, but let's get into callable bonds, or when you have mortgage bonds where you're going to get principal payments back earlier than anticipated, that's called option adjusted duration or effective duration. And so that's the best measure to use when you have callable securities. Complicated calculations for sure. You really need to have a system that does that. Hard to do on an Excel spreadsheet. Hopefully this picture explains a little bit more, a better way to look at duration. So duration is that holding period at which the present value of the periodic interest payments is the same as the present value of the maturity payment. Where Macaulay was getting, where's my point where I have that balancing point between coupon and maturity payments? And so he was talking about taking the present value of coupon payments and the present value of the maturity payment. And so, for example, a 10-year bond in a high interest rate, it has a high coupon rate, would actually have a much shorter duration of 7 years because you're going to have all those high coupon payments. But then you take it to extreme and you have a strip or a long-term treasury bill that you have no coupon payments. Its duration is 10. It's the same as its maturity because you don't have any offsetting coupon payments over that time period. Now, to get even more in the mathematical weeds of bond calculations, let's talk about convexity. Convexity is the second derivative of duration. The first bullet point, because duration is a linear assumption, it miscalculates the change in price of a bond given a change in yield to maturity. So you can see on my graph on the left, that linear relationship, the red line, that's how bonds might operate, but they really don't when you factor in present value and coupon payments that have that convexity, kind of curvilinear look at it. And so convexity, the third bullet point, measures the curvature of the price yield relationship of a bond. And it's a better way to estimate a bond's price change with a corresponding change in interest rates. Now, shorter term bonds, such as just 2-year, you'd have to take a magnifying glass to really look at the convexity, the curvature of a 2-year bullet. It's very linear. But you get out 10, 20, 30-year bonds, very much you have that convexity aspect of a bullet. On this slide, I'm talking about the convexity of callables. They actually have a negative convexity if you look at the graph, where bullets have a positive convexity. So as interest rates drop, the value of bonds go up, but callable bonds are limited because eventually they're going to be called at par. You know, most callable bonds have that feature. They're going to be called at par. Some have a premium call, like municipal bonds that you might issue from your entity. But let's just use regular agency callables or corporate callables. And so they're going to be called at par. So if interest rates drop, you'll get a little bump in price of the callable, but you think about it from the buyer's perspective, who wants to buy a callable much above par that they know eventually, if interest rates stay low, it's going to be called at par. So it has negative convexity in its prices compared to positive convexity of bullets. Let me sum up duration and convexity by talking about where is the yield curve sweet spot for an operating fund. We know, as I mentioned earlier, that if the longer I can invest, the more I'm going to earn over time. For example, here is the U.S. Treasury curve 1990 to present, and we see if I buy a 3-month T-bill, I'd earn around a 270 out to a 10-year Treasury note around a 430. And so, but an operating fund, California code, we generally have to stay under 5 years. And so what I did on this graph is I looked at the average yields from 1990, and we see the 3-month Treasury bill has a 2.71 all the way out to the 10-year T-note at 4.41. And so, but after I meet my liquidity needs, let's say after you run your cash flow model, you decide, hey, I can run with 30 or 40% in liquidity funds under a year, and then I can take 70 or 60% out the yield curve. Where's that sweet spot? What's the average WAM, weighted average maturity, or duration that I can have? So we look at doing the modified Sharpe ratio analysis. And so how to do that is we take the average yield of the 2-year, which is 326, and we subtract the average yield of the risk-free rate, the 3-month Treasury bill. And one could argue my risk-free rate really should be the 1-day Treasury bill, but there's not an index I could find. So there's not too much difference in interest rate risk in a 3-month bill and a 1-week bill. And so we just see, we subtract that, we risk adjust or divide by the duration, the 190 average duration of the 2-year, and we get a 0.291. And that's the best modified Sharpe ratio. That will change over a shorter period of time, but I want to do over the long run. Another way to look at it is this last column, the return of the 10-year, the yield of the 10-year is compared to the risk of the other instruments. So for example, the 326 yield of the 2-year Treasury versus the 447, oh I see I have a slight typo there, it should be 441, of the 10-year is approximately 74%. So my 2-year earned 74% of the 10-year's yield over this long period of time, but 190 duration versus a 796 duration, it only has 24% of the interest rate risk, so therefore that highest risk-adjusted return. I'm going to now shift to credit risk. We see the lower risk instruments such as government LGIPs or LAIF, government money market funds, government repo, T-bills, discount notes down at the bottom. We move up to commercial paper, asset-backed securities, corporate bonds, lower rated bonds, and futures, the higher risk. Here's some pros and cons of taking on credit risk in your portfolio, buying commercial paper, corporate medium-term notes, etc. So pros, increased income. There's almost always a positive spread because I'm taking on more risk. Diversification benefits. I can diversify into different industries. Company transparency. They typically release earnings quarterly. You can get more information versus buying a municipal bond, which has once a year CAFR. Relative liquidity. Depending on the corporate issuer, their corporate bonds are fairly liquid. Then on the other side, of course, we have default risk, the one we're worried about the most, like Lehman Brothers. It takes deeper analysis at purchase and then continually monitoring what's going on with that company, the economy, the top-down, bottom-up look, and definitely less liquid than treasuries. Sometimes they're more liquid than agencies, depending on if it's a small agency issue and you have a big corporate issue like a Microsoft, for example. On the left-hand side, you can see the 3 primary rating agencies, and there are other rating agencies, but these are the big ones: Moody's, S&P, and Fitch. And so in California, we have to buy above the red line there. And so we don't necessarily, if we have something that's downgraded, we don't have to sell it per se. You might have something in your investment policy that would be the case. But you can see the various rating categories there, from prime down to upper medium grade. On the right-hand side, I call this my 1 to 5 year fixed income supermarket, where I'm looking at treasuries, agency bullets, agency callables, and then various corporate issuers. And we can see as the further you go out the yield curve, let's just take a look at some of these, of course. And I showed you this graph a little earlier with callables. You get a little wider spread the further out the yield curve you go. You're taking more risk, you better get paid for that. For example, Wells Fargo. You look at the 5-year Wells Fargo, which this is the Wells Fargo company versus the bank, so it's the holding company, which has a lower rating. It actually has a BBB plus from one of the rating agencies, S&P right now, where Fitch and Moody's have it in the A category. But be that as it may, it has much wider spread and higher yield back in December of 2020 when I ran this analysis. And then you look at ExxonMobil. Oil had dropped down and is still pretty low as compared to the past. So ExxonMobil, being an energy company, has had a challenge during COVID, and so it has a little wider spread. And then the next one down, Toyota. We haven't been buying as many cars, and so Toyota and Honda and other the auto manufacturers have had a little wider spreads. Then you get into the technology, Microsoft and Apple, and then a solid company like 3M, which has a high rating, and we can just see the tightness of those spreads. But then you get down the yield curve, you go down to 1 year, and you can see the Wells Fargo is yielding similar to the other corporate bonds because you only have 1 year of risk of worrying about Wells Fargo not paying you back versus 5 years of risk. So the further out in time you go, more duration, you're also taking on additional credit risk of time. Now, going back to the Lehman days, if you owned a 1 week commercial paper of Lehman versus a 30-year Lehman bond, you're essentially in the same boat getting only about 30 cents on the dollar in the bankruptcy. So if a company files bankruptcy, all the bonds are, a similar boat as compared to looking at the credit risk. So the market is showing, hey, I have more time to worry about, so I'm going to pay you a little bit more on Wells Fargo 5-year versus a 1-year spread comparison to others. This graph shows corporate spreads and asset-backed security spreads to treasuries over a long period of time, approximately 20 years. And so we see the corporates 1 to 5, A to AAA, 1 to 5, AA to AAA, asset-backed security credit cards, and asset-backed security autos, which are both AAA rated. We can see during the great financial crisis back in 2008 that things widened, the spreads widened as compared to treasuries greatly. And then we look at during COVID, they widened a bunch there, but the Federal Reserve stepped in with so much more in programs and help to the corporate market, and so much faster this time than back in 2008. They kind of learned their lesson from that perspective, that spreads didn't go as wide. And you can just see that, but you look at the average spread over time. I did that down in the box, and I didn't calculate it without those really wides because that actually happens. I wanted to have those in the calculations. But you can just see over time, if you're going to buy in the A up to AAA rated category, you're going in the 1 to 5 year sector, which is the typical purchase for California entities. You're going to average about 30 to 40 basis points on your purchases. Now, many entities, they won't start by buying an A-. They might hold an A- if it gets downgraded, but they wouldn't start. So therefore, you don't get as much spread there. But this just gives you a good idea. Is credit worth the risk? You have to make that calculation to see if you decide if it is. Now let's take all that I've talked about with credit and interest rate risk into reality. These are real portfolio comparison here. So look at the pie graphs on the right. So the shorter duration portfolio, which is the dark blue line, they have an average duration of 1.1. And so you can see the credit, though, is 55% of the portfolio buying corporate bonds, commercial paper, as compared to 45% on average in treasuries and agencies. Now there's a longer duration portfolio, double the duration, about 2.1 duration, has 80% on average in treasuries and agencies, and only 20% in credit. And so I start these portfolios at the same time frame back in 2008 when they were both yielding about 4.5%. And when interest rates went down, when the Fed cut rates to zero essentially during the great financial crisis and kept them there until late 2015, you can see the longer portfolio, its low yield was 1.13, where the shorter duration portfolio was 0.38. And then as interest rates started to rise, the shorter portfolio had maturities faster and they rolled off sooner. They could reinvest sooner and got back up to almost 2.5%. But then again, back in 2019, the Fed started cutting rates even before COVID and taking them down to zero, of course, last year in 2020. The shorter portfolio started to come down. So over this about 12-year period, you see the blue box in the middle, the longer duration had an average yield of 1.84, and the shorter duration 1.28, or 56 basis points differential per year. And these are multi-billion-dollar portfolios. And so my main point is duration is the biggest driver of returns for the vast majority of portfolios, because the longer duration portfolio had less than half the credit risk. So earning that extra little incremental yield from credit just really didn't pay off as compared to the duration differential. That is the biggest determinant of return, is duration. Another aspect of the relationship of risk and return is liquidity risk. And so when we buy corporate bonds or an agency callable bond and we buy it and we want to sell it, there's a bid offer spread. And that's usually wider than a treasury because they just don't have as much issued as the treasury market. It's the biggest fixed income market in the world. And so you have that liquidity risk in the sense of needing to sell it back. It's just not as liquid, not a credit risk from that perspective of liquidity. But I want to go back in March of 2020 when the markets were just crazy and the treasury markets had massive bid offer spreads compared to how they usually have had. So this graph actually is April of 2020, April 7th. And so I highlighted in yellow there a very short term, and so just 3 months from April 2020 it was July of 2020, a Treasury bill had a 5 30-second, so one par 13 30-seconds versus par 18 30-seconds bid offer spread. And you can see these were trading at negative yields, these short-term treasuries back then when things were so crazy. And so it's incredible the differential between the yields here. And so I took the 113, and you can see it's a 53 basis point bid offer spread in that red box there on the bottom. Sorry, that's the price, not the bid offer spread. And so the yield was 30 basis points that you could sell it. But then to buy it above that, par 18 and 5/8 30-seconds, that's a minus 23 yield. So a 53 basis point bid offer spread. These will usually trade 1 to 2 basis point bid offer spreads on short-term treasuries like this. So that was such an unusual time, even in the treasury market, for liquidity risk. Now you go out to the agency and the corporate market, even wider. Let me finish up the last section of risk and return by talking about market timing risk. And so I have my little homer saying dough there for trying to time the market. And so S&P Dow Jones Indices goes out twice a year, and they look at how actively managed funds did versus passive benchmarks. And these are the funds that are trying to outperform the market. And so you see that top line there, that's government long-term funds. So these are the number of funds that were outperformed by their passive benchmarks. And it's terrible. 1 year, 91% of them were, out to 98% basically all the other years. And then government short-term funds, that's the area that we all invest in, 1 to 3 year government. It's not much, I mean, it's better, but it's not much better. I mean, the best was 68% of the funds were outperformed, so only 32 did better than their passive index. Then we get into adding credit there. It's still challenging, where they just have a hard time outperforming the market. And the ones that outperform, let's say this 5-year period, they're usually not the same ones that outperform the next 5-year period. Another thing I like to track in regard to timing the market is looking at this Philadelphia Federal Reserve's survey of professional forecasters, the people that are professionals that really should know. And so this graph is of the 10-year, the forecast. The black line is the actual 10-year Treasury. And so they ask all these forecasters, can you tell us quarterly what the 10-year is going to do over the next 3 years? And you can see they were mainly optimistic there, just thinking interest rates are going to go back up, and just wrong 90% of the time in the magnitude and the direction. More than 50% of the time they were wrong. So really challenging to outperform, to time the market, I should say. The one indicator that I have found that's really good at timing the market is looking at the shape of the yield curve. And so I call this the yield curve trap. I'm a big Star Wars fan, and there's the commander of the rebels who thought that the Death Star was not operational, and we know it was operational, and Darth Vader got him in the trap there. And then anytime I can show Baby Yoda, it's a good day. So let's go back to 1989. That's when I started with the City of Las Vegas, my first year in public funds. We had a 9% flat yield curve, that upper blue line. And I thought, why on earth would I invest 5 years at 9% when I can buy a 3-month bill at 9%? Now, 9%, you're saying, that's crazy, but inflation was really high back then. And so I learned my lesson, because rates dropped. A flat or an inverted yield curve is pointing to rates going down. The economy is slowing, and so market participants have bought things and pushed the yield curve down, and we see that's what happened, dropped 600 basis points. And so I learned my lesson in 2001 when the yield curve was flat at 5%. I didn't try to time the market. I just matched cash flows and still bought the 5-year and was really happy. And then coincidentally in 2006, 5 years later, when we had the great financial crisis getting ready to start, we had a flat yield curve at 5%, went all the way down to 0, essentially, dropped 500 basis points. And then I put current in the sense that that blue line, 12, 19, 18 on the bottom right, that's the day of the Fed's last hike over 2 years ago. And so we had a 2.5% basically flat yield curve. And we know that it's dropped down to 225 basis points, essentially down to 0 for short-term rates. Now let's look at the effectiveness of this indicator. This table shows how good this indicator has been. It has had an 8 for 8 track record. And the way I like to look at it, and many in the market, is looking at the 10-year yield versus the 3-month treasury yield. And so obviously most of the time the 10-year yield is greater than the 3-month bill yield because we take more risk, we need to get paid more. But when it inverts, that points to a recession and the Fed lowering short-term rates. And so I go back to 1969 and I want to make sure that it's a good signal. So it has to stay inverted at least 10 consecutive trading days. And so it did that. And so the first one is January 10th, 1969. The curve was inverted for 24 days. And then from that date, how many days till the next recession? That was December of 1969, so 325 days. And you can see the various ones down there. So we actually, the yield curve inverted in 2019. The Fed was cutting rates and the economy was slowing even before COVID. And so we see the yield curve inverted in June of 19, was inverted for 41 days, and the recession started 268 days later. Now, I don't think we would have had a recession so soon if COVID wouldn't have hit. Maybe we would have gone another year, but we were slowing, the economy was slowing, and the graph on the right-hand side just shows that when it inverted, and then of course the Fed cut rates down to 0 in March of 2020. So it's been a really great indicator of looking at predicting a recession and a decline in rates. Well, that concludes my presentation. Thanks so much.